Great. Good afternoon, everybody. We're going to do real estate today. My name is Matthew Kessler. I've had the pleasure to work with Marty for several years, emceeing real estate, venture capital, fund of funds, anything that's alternative investment oriented for him. And today I get the pleasure to talk real estate. And I want to thank, obviously, Kevin Sher, who's a partner here at Greenberg, Glusker, and say thank you for hosting us. So thank you very much. It was very kind of you to bring us in today. I think for those that are in the room that are family offices and those that are online, you're really going to hear a nice eclectic group. We have a lot of different, expertise in terms of the individuals who they represent here on the panel. So I think we're going to hear a lot of opportunities for you, the family office, on, okay, how do I put my capital to work? If you're a traditional family office, you have $1 in the portfolio and you've got to break it up. You've got to figure out how much to real estate, how much to healthcare, how much to cash, how much is it actually going into the giving pledge? What are you doing with, the liquid assets, whether it's in, stocks and bonds and ETFs and mutual funds and closed-end funds? That's your portfolio. So real estate tends to be the predominant part of any, large portfolio. Let's call it $100 million or more. And then for those of you also listening today, you're also thinking, how do I get into these different asset classes? How do I get into a fund of real estate investments? How do I get into, say, residential real estate building? How do I get into an area of storage like our good friend Ken behind us? How do I do the things that I need to do? And then again, how do I get represented correctly? Obviously, Greenberg, Glusker, and, the law firm. So I think this panel really puts together all of those different aspects of real estate that can help you, the family office. So just know that you've got a lot of resources here today. So to my far left, I've got Anil, Ranavat, CEO, Cedar, Porch Capital. And if I'm correct, your firm is brand new. You're about 3 months in the business. Is that correct?
That's correct.
That's correct. So, let's applaud him for taking that big step of launching a brand new firm. Kevin Sher, partner, 18 years, Greenberg Glusker on my right. And then in the middle, obviously, we've got Rich Gupta, CEO and founder of Ascent Investment, as well as R&I Advisor, Inc. And then Ken, who I have interviewed, Nitzberg. He is chairman and CEO of Inland Devon Self-Storage Holdings. I have interviewed and had the pleasure of being with Ken multiple times on these platforms. So I think you're really going to get an amazing insight into, obviously, the storage business and what he brings to bear. My background, I've been in real estate for about 25 years. I've worked at BlackRock and Guggenheim and UBS and Merrill Lynch. The firm that I work for is called MENLO Pace. We're a balance sheet lender. We have several $1 billion in our balance sheet to lend out for property assessed clean energy, as well as senior debt. So we'll talk about that a little bit later. And then also, I think what you're going to learn from the other speakers is that there's just amazing opportunities. So I think we should just sort of get into it. I'm going to start with Rich. I'm going to ask you a couple questions. Now, Rich and I were talking yesterday, and I thought what was really interesting about his business and his family office is that there's 7 partners in his family office. Now, think about that. There's 7 partners in a family office. You've got to think about, okay, who runs the family office? Who makes the decisions? How do you say yes or no to an investment? And more importantly, this was established in 2011. So we've really got a very tenured family office here. And what he was telling me, and I'd love you to talk about it for a moment, is that he needs unanimous consent of the 7 partners to say yes to a project, which I thought was fascinating. Not 1, not 2, but you've got to have big consent across the board. Now, their focus is buy, hold, sell, and finance. Family office, really different from all the normal family offices we think about, Gen 2, Gen 3. They invest normally in deals as a family office anywhere from $3 to $15 million. So let me ask you a question, Rich, in terms of your portfolio. It's comprised right now of about 5 assets, and you've had about 22 dispositions. Tell me a little bit about how this board was put together and who makes the rules of when you do and don't get to buy or sell an asset.
Very good question. I tell you, you got to go back to Genesis of formation. We formed our multifamily office of 5 in 2010, early 2011, and we were just winging it. Ex-Wall Street guys, buy-sell side, and decision-making was pretty chaotic. And then we became apparent to us that 2 more joined us. It became apparent that we have to put some rules of engagement. And we consulted some folks who we know in the industry.
As their doctors, their accountants, their other practices. So what becomes key is either finding the particular partners and investors who are willing to step up into those management components, or finding really good third-party help. And third-party help can be in the form of property managers, asset managers, or I'm dealing with one client where we're at the stage where we've brought in fiduciaries because it's a family enterprise with a lot of trusts. And at this point, with infighting in between family members, we had to bring in outside parties to be able to have an independent approach and to resolve certain disputes and potential litigation amongst them. So it's a tricky prospect.
Very tricky prospect. So let me just take one more question that you and I were sort of chatting about yesterday. You gave me this amazing example. There's 18 LLCs, in a particular family. You needed a decision quickly to either dispose of the asset or to buy the asset or refinance the asset, but it took you months because you had to go back to the 18 to make sure that you had either a majority to get this decision made. How'd you handle that with 18 different individuals?
Yeah, so for some of these, it's not even an LLC. They're still in general partnerships.
Oh my God.
And part of the advice to them has always been, let's get you out of the general partnership format. Let's get you into an LLC. Let's talk about these management decisions, because otherwise, yes, we're trying to negotiate a lease, and at the same time, we're going around and calling up people, some of whom haven't participated in this venture or been interested in it for years, and trying to get their sign-off participation in order to move forward. And it's incredibly inefficient. And so we do it because it's necessary, but there are so many ways that we could plan to avoid this and increase efficiency and get the deals done faster without having to act person by person committee style.
Again, you must have a lawyer's lawyer on your staff, so you can see how it makes sense. So Anil, thank you. Welcome to the group.
Thank you.
And again, congratulations on, your new firm. But he's not new, right? He's, 25, 30 years in finance, big background in, putting together monies for different types of transactions. And then with your firm, you're building homes, you're financing those homes. It could be a large community, 300-400 houses. It could be 200 houses. It could be 50. Talk about the financing side of that. And more importantly, I've got 100 acres. I'm in Texas, and I'd like to put together, a nice community. Are you the individual I would pick up the phone and call and say, okay, let's finance these 100 homes. I'll be the developer. You're my bank.
Thanks very much. So Anil, Ranavat, I run a firm called Cedar, Porch Capital. So nice to see you all. And I focus on the development and construction financing for single family residential homes. So in that capacity, yes, I would work with real estate developers and home builders that are looking to build communities of homes for rent, for sale. It's a very interesting sector within real estate in general. I think, probably a lot of folks are pretty aware, but there's a meaningful shortage of homes in the US in a lot of different markets. It's very hard to get construction and development of homes going in the level that we need them in the US. And so I am financing both debt and equity, a lot of those projects. What we see is, even though there are incredible tailwinds in residential real estate and very good underpinnings in that market, financing has been affected by a lot of other areas in real estate, such as office and other areas that have had secular, headwinds. And that has spilled over into the financing of residential real estate as well. So you can get very attractive returns in financing residential real estate construction and development in a subsector of real estate that actually has very good tailwinds. And you can get those attractive returns because a lot of the investors that I'm working with that are institutional investors are really demanding the same returns that they are getting in other sectors of real estate.
And how would this be different than, say, build to rent?
So build to rent is a big component of what I do. So build to rent is basically, build the same community of, 500 homes and you put them on rent. That's about half the business. The other half is building homes to sell to customers. So you have both the rental option and the sell option, just like with an apartment building. You have the condo option and the rental of an apartment option.
Nice.
All single family?
All single family, and there's also bleed over between single family and apartment buildings as well.
So our next speaker is Ken Nitzberg. Oh, yes.
Real quick, on your built to rent construction projects.
Yes.
or Financing, how much exposure do you have to California, or are you mainly more in the Midwest?
Will you repeat the question?
Yes, so the question is, how, in terms of geographic exposure, is the concentration mostly in California or in other areas of the US? It's the latter. It's mostly in other areas of the US. There are, of course, California projects, but most of the growth is in the Sun Belt, southern portions of the US, Southeast, et cetera.
So now I'm going to introduce Ken Nitzberg. Nice to see you back there. How are you?
I'm just fine, thanks. How are you, Matthew?
Good, that's good. Nice to see you. Ken is the chairman and CEO of Inland Devon Self-Storage Holdings. He had founded the company in 1988, which means 36 years. Vertically integrated platform, 150 self-storage facilities with a market value today of about $2 billion. So Ken and I obviously were on a call yesterday to catch me up. Somewhere north of about 18 facilities currently under construction, locations in about 27 states, about 250 employees. So, I'm sorry. 250 employees, and somewhere, north of about 7 million square feet under management. So Ken, one, congratulate you on that. I mean, that is such a feat to cobble together, during the 36 years, that type of a business. And recently, if you'd sort of tell the group the story, because this happened in February, that Inland Real Estate Group of Companies, Inland Private Capital, and your firm became one. Why don't you tell us a little bit about that story?
Sure. We've been working with Inland for a number of years. They're a 55-year-old privately held real estate company with about 17 billion under management. And they're in all the sectors, multifamily, retail, commercial, industrial, hotels, student housing, senior living. And they typically manage everything themselves, but in storage, they didn't. And they had about 170 stores. And we managed about 90 of them and had another 18 under construction on their behalf. And we just started talking and they said, we'd like to bring you into the family. And so we can now manage all the self-storage assets. So we did that in February. And since February, we've added 70 stores to our portfolio. And as of this morning, we have 153 stores, about 2 billion in market value. We're in 34 states. We have correct my numbers because I had a check yesterday. We have 350 employees. I'd rather have 250. Payroll every 2 weeks still scares the hell out of me. And we're growing. And Inland obviously wants to grow their portfolio, but they're also very active in having us go out and do third-party management for people that have 1 or 2 or 3 stores or 20 or 30, as well as additional accounts with institutional investors and high net worth family offices, of which we have a bunch already. For example, the Employees Retirement System of the state of Texas is one of our accounts. We have 5 properties with them. And over the years, we've had, our clients have been the State of Michigan Retirement System, the General Mills Pension Trust, Harvard's Endowment Fund. And I could go on for 20 minutes with these different firms because, a lot of institutions have figured out that storage is a pretty interesting area to invest in. And then they figured out it's a whole different critter to manage. Yeah. We have 7 million square feet roughly, and we have 56,000 tenants on 30-day leases. They're not even, rental agreements. They're not legally leases.
Right.
So it's, we have thousands and thousands and thousands of little things that could kill us, but no one big one.
So let me throw sort of a big question I think we can all tackle here, in Century City, which is why do 20 of the top MSAs have a moratorium? Why do they have a moratorium on storage facilities?
Well, it's not the top 20 MSAs. There's a number of cities, a lot of suburban cities. Cities don't like us. It's real simple. Mm-hmm. They don't like us for 3 reasons. Number one, cities historically live off sales tax, whereas school districts and counties live off property tax. Unless you have something like San Francisco, which is a city and county in itself, and they live off everything. But we don't generate any sales tax unless we have, in the office, we sell some boxes or locks or packing material, but the rents aren't taxed, except there are 5 or 6 states that do tax self-storage rents, which is a bit of a slippery slope because when is it going to be taxed next for apartment houses or office buildings or retail? Because I can't name one, and I challenge anybody listening today to name a city, state, county, special purpose district, you name it, that isn't broke if they did the books like we have to. So they're always looking for new revenue sources. So they don't like us because we don't have sales tax. That's why you look at any four-way intersection, two major streets, every corner's got a strip center or a CVS because they pay sales tax.
Right.
Secondly, when we're all done, if we build one, if we're all done, we have 2 employees. So the city council person whose property we're in their district can't in their next re-election campaign say, look, I brought this new business to town and created 100 jobs. And the third is perception, because we walk into the mayor's redevelopment office and say, we want to put up a self-storage facility in the corner of Main and Main in your city. And what they see in their mind's eye is a 1970 vintage facility, bunch of long rectangular metal buildings with dinged up corners, orange doors, courtesy of our friends at Public Storage, cyclone fencing with concertina wire on top, dead cars and trucks parked everywhere, and a couple of Rottweilers running around at night howling at the moon called security. And they say, you want to build what, where? Yeah, we'll give you a zoning change and a building permit as soon as those pigs start flying. So, you know, we're just not their first choice in most cases.
I totally get it. I totally understand. So thank you for that moment again. Congratulations on, you and your newest company coming together. And in that vein, Rich, let's talk a little bit about an asset class that just got a black eye recently for like the last 5-6 years because of COVID. And that would really be office space. And you keep telling me that it's a tale of 2 stories. I'd love to hear that. Why is it a tale of 2 stories?
Well, I mean, you look at office towers and office buildings, the tale of 2 stories are based on predominantly, if you look at the money center cities, which I call money center cities, which is downtown LA, downtown Manhattan, or San Francisco, or you go to Boston, you go to Chicago, all those towers, the folks are not coming back to work. This is the first time in history of the United States where the people are just not traveling and going back to work. That's the one story. The second story is you live in a suburbs like we do, or some of you guys probably live as well. Office towers are non-existent. You have maybe 1-story or 2-story office building. You cannot find a space. They're either fully leased or so-called prorated fully leased. Can't find a room. So as such, it's supply and demand. Most of the society moved to suburb, and they are very happy to either work from home or you drive 5 minutes or walk 20 minutes to get to your place of work, which is suburbia. So till that changes, office towers in money center cities, story will still keep playing.
So Anil, let me ask you to sort of pick up on that theme. How can a community of single family that you're financing and pulling together, whether it's 100 homes or 200 homes, take advantage of what just happened with COVID and office?
Thank you. So I was 16 years in private equity and private credit, mostly in New York. And those are a lot of the investors that I bring into deals on the residential side. And exactly, what Rich has been talking about, of course, they see opportunities to redevelop office and change that into multifamily and other, asset categories. But generally, it's been a big tailwind around residential real estate because people are working from home. They're demanding bigger, home footprints. So square footage, demands generally have been going up, offices at home and the like. And also a lot of move to suburbia. This occurred during COVID. And so a lot of that has resulted in a lot more demand for homes. And as interest rates have increased, a lot more homes for rent as well. So both demand for homes for sale as well as demand of homes for rent have increased. And with that, a lot of the investor appetite is shifting over to financing those big communities of homes for rent and for sale.
So Kevin, let me sort of throw the ball back at you. Let's talk about, the distress. We just talked about the distressed office market, but more importantly, let's talk about that real estate management standpoint, right? Because if it's office is a tale of 2 cities, you've got a single family residence inside a community. Well, that needs management standpoint. And now I'm a wealthy investor and I come to you and I say, okay, I need succession planning. I need to figure out what to do with Gen 2, Gen 3. Talk about that hard talk you have either with, the family member who started the business or that hard talk with, Gen 2, Gen 3 about succession planning and what it looks like. I think that's just so important in our business today.
Yeah, so certainly in these times of uncertainty in a lot of the different real estate sectors, when Gen 1, who has built up a company in perhaps a time of lower interest rates, perhaps a time where certain sectors like the industrial sector, which has been booming for so long and has now maybe flattened a little bit, but is still performing relatively strong. They need to think about not just their management succession, but also the type of asset classes that will have staying power for their portfolio. So in terms of the property management aspects, there's a conversation that needs to occur over how much they want to keep their hands on and how much they're going to farm out to third-party asset managers and property managers, and finding good people and keeping an eye on those folks as well. Because I've had too many circumstances where a client has bought a far-flung property. Let's say they live in California, they buy something in Indiana, they hire a property manager that they got through word of mouth, and then they never keep apprised of what's going on at the property. And the surprise, surprise, they find out 5 years later it's not being managed in the way they would like it managed. So there really needs to be a concerted effort, not just from Gen 1, but Gen 2, who is going to be following these third-party property managers and making sure they do their job so that the property performs best for the portfolio.
And so you insert yourself into that situation.
Yes, so I insert myself both based on the negotiation of those property management and asset management agreements, and also keeping them on their toes on the third-party side to make sure they're performing their job on a regular basis.
Right. So important to the conversation. And Ken, let me come back to you. Chicago, Philadelphia, two places where I know you do not like to invest. Talk to me a little bit about that property tax issue that you told us yesterday on our call, that if you took that property tax that they hit you with almost every 12 or 13 years, you could just buy the property again. Why do you think that, it's just so prohibitive to do business in Chicago and Philly?
Well, Chicago is affectionately called Cook County, and my guys call it Crook County instead of Cook County. Got an R in there, as the taxes are just crazy. And we appeal everything every year, and we're successful more often than not. But still, it's gotten to the point of, I've just told our people we're not buying anything else in the proper city limits of the city of Chicago, or in Cook County for that matter. Life's too short. Philadelphia is a whole different issue. There, I don't know whether there's corrupt or stupid, but the tax situation, they have something called the business opportunity tax in Philadelphia.
Mhm.
You get to pay a tax for the opportunity of doing business in Philadelphia.
Wow.
It's nothing to do with the property tax or income tax or anything else. It's business opportunity tax. So you got to give them credit for creativity. But the bottom line is, this just sucks your cash out of your projects.
Mhm.
And that doesn't apply just to storage. It applies to office buildings and retail and everything else.
We have a question from Marty.
Hey, Ken, what percent of the assets that you're managing right now are in opportunity zones?
Opportunity zones?
Yeah, is that the thing?
That's a whole different critter, Marty. But let me tell you a very quick little story. We got a call from Inland, from the CEO of Inland, about 7-8 years ago, saying that they have been looking at self-storage and they really wanted to get into it. They hadn't done it yet. They talked to people all over the country, and they all said that we're the firm to call. So he was calling. He said, can we do a joint venture with $300 million? And I said, yeah, I really am flattered and I appreciate that, but we don't have any bandwidth left. We just did a 22 property deal, bought them from CubeSmart, one of the REITs, on behalf of the Sovereign Wealth Fund of Kuwait. And I said, we don't have any more bandwidth. He said, well, can we keep in touch? And I said, sure. So about 3 years later, he called me back and said, how about now? And I said, sure. And we bought a little project in Houston, and we bought a little project in Grand Rapids. And then he called me one day and said, we like what we do. Our main business has always been conversions. We buy vacant buildings that have gone black, that have gone dark, that nobody can figure out what to do with. My favorite company in the whole world, as Marty's heard me, or Marty and Matthew heard me say, is Kmart. Every time you think you found the last dead Kmart, you find 5 more. They're like cockroaches. They never go away. And they're perfect because we can buy them for 20, 30 cents on the dollar. You've got a distressed owner is getting no income, is paying taxes, and we convert them to state-of-the-art facilities and keep moving. So he said, we can't do your conversion deals because we are basically 1031 exchange guys. They need income on day one to pay the people that sold their duplex and put the money in one of their funds. Big DST funds out of, Delaware statutory trust funds. He said, but we really like the conversion deals. Do you do conversion deals in opportunity zones? And I said, of course. What the hell's an opportunity zone? Because, my buildings don't know where they are. They don't care. So
Right.
he explained it. I said, of course, that's most of the deals we do. That's why they're vacant. So he said, if we put together $100 million fund, could you raise the money? And I said, do the deals? I said, of course. So they put together a fund in middle of 20 and went out and raised the $100 million and we placed it. And they came back to me and said, we've got a green shoe on this for 50 million more. Could you raise it and place that? And I said, sure. What am I going to say? No. So they raised that by September of 21. And as I assume most of you know, the opportunity zone section of the 2017 tax law expired December 31st, 21, unless Congress re-ups it. And right now, Congress doesn't seem to be able to find their rear end with both hands and helpers. So I'm not holding my breath on that. So he said, could you put together another 75 million? So they filed another offering in September of 21, and we screwed up again. They raised 110 and we placed that. So now we're busy converting all these because, as you may or may not know, to get the tax credits, which are huge with these opportunity zone projects, you have to invest 50% plus $1 more than you paid for the asset. So they raised $260 million and we'll end up doing about $750 million worth of self-storage with that money.
Amazing.
And that's the stuff we're still constructing right now.
So let me move on here to Rich. So Rich, you and I talked about recreational assets. We talked about hotels. We talked about motels. We talked about, finding funding for these markets and deals. Talk about where you're finding funding. I think it's very difficult out there with equity at 12 and 14%. Most players would love to say, 350 over the 10-year treasury. That doesn't exist. Where are you finding funding?
It's mostly private capital. I mean, obviously, banks are out of business. Equity has gone up. I mean, equity money can sit in the bank account and get 5.5%. Why would they want to deploy into any hotel, motel properties? So there's a risk and reward. And we can source the capital from sovereigns, from the regular cast of characters. They all have capital, but the cost of capital has gone up tremendously. So as long as the project pencils in, equity is there, preferred is there, debt is there, all level of debt is available, but cost got to make sense and you got to paper out.
So I come to you with a project, or you have a project, your family office has a project, the seven of you. How many sort of private debt facilities do you have in your back pocket? How many banks do you talk to on a particular deal? Are you going to PE funds? Like, where are you actually going to get this done?
No, we haven't done any trade with PE funds.
Good.
Our transactions are mostly some other family offices.
Mm-hmm.
We may take our own money stake as well, a small percent thereof. We may outsource the whole thing, either through sovereigns or multifamily office or insurance funds. Insurance funds have a big appetite for real estate, all kind of real estate, but cost of capital has gone up.
You're right.
And as long as the project pencils out, I mean, we are looking at a couple of them, especially the one in St. Kitts. It's an amazing project, Ritz property, and they will have about 110 individual lots also parceled out, which they will start to sell hopefully towards the end of next year. And the Ritz is going up hopefully before 25. And we are raising the whole capital for Ritz.
Wow.
Equity and debt.
Wow. No, that I want to come back to that. So Anil, let me ask you. Okay. Anil, let me just ask you a question about senior living. Are your communities, because they're all single family homes and they're financed, are you seeing seniors moving into that type of a community?
Yes, absolutely. Either moving into those communities or staying put in those communities. So one of the big demographic drivers is, baby boomers are typically staying longer in their homes. At the same time, as millennials are really trying to move into more homes, which is, a big demand driver. At the same time, that supply of homes is very tight. So one thing I'll pick up off what Rich was saying as well earlier is debt financing is challenging for a lot of construction and development. That allows you to earn teens returns in debt in construction and development, and arguably one of the most attractive asset classes within residential real estate, within the broader real estate ecosystem, which is quite attractive. The other thing is if you're willing to take equity risk, and that equity risk can be preferred equity. So at the very top of the
Wait, so are you
equity
talking about
stack.
family offices who are doing what you're doing or those that are investing?
Those that are investing.
Okay.
So effectively, if you said, look, I've got a part of the portfolio where I want to take a little bit higher risk, I want to be preferred equity. So right below the debt and above the common equity.
There we go.
That sliver, because institutional investors are not doing that, you can get to 20% type returns in a arguably right behind the debt type position, which is, typically 75 to 80% loan to value. So in that sliver, you can earn a 20% type rate of return. That's just an example of the opportunities that I think you can get if you're willing to take equity risk in the current environment.
Thank you. One or two firms you like that are actually offering that sliver in the cap stack?
So a lot of the projects that I work on, so you can think of Cedar Porch Capital as a potential investment opportunity around that. A lot of those projects, you go directly into the projects. So if it's a community of 100 to 500 homes and you want to be the preferred equity in that development, you would basically be sitting right behind institutional
So
investors.
it's like a sidecar, you get to pick, you get your own preferred returns, you get to sort of figure out what you want.
Exactly.
Yeah, got it. Cool. All right, so let's go to my favorite topic at the moment. And I'm going to come back to you, obviously, is this ULA tax. How many people know what the ULA tax is? I got one hand in the entire room. Unbelievable. So this ULA tax, which is just, I got two. This ULA tax in Los Angeles affects not only residential, and again, I have to, sort of say what I do and don't know sometimes. I didn't realize this tax also affects commercial.
Yeah.
So in the commercial world, it can potentially become very, very difficult for a owner of a commercial real estate, as well as for, the 5 million below and above residential real estate as it changes hands. So when we were talking, Kevin and I said to him, okay, you've got a 4% tax on properties that sell for more than 5 and 5.5 that are above 10. And I said that we all know that it took, effect last year in April. I said, so how is this changing the commercial market as well as the residential market? And then I want to hear from you as a lawyer, how do I avoid some of this tax?
Yeah, so Measure ULA, right before it went into effect, caused this big flurry of activity where, especially in the residential markets, but in commercial as well, people were selling to avoid this.
Now,
This
when
is
was that? What year was that?
This was in 2023,
Okay.
and it went into effect in April. So you see in Q1 of 2023 in the city of Los Angeles, just more deal volume,
spike.
than you would see in prior years, certainly even with the pandemic transaction boom that we had. So big flurry of activity, and then it went into effect and the deal volume just plummeted because it is extraordinarily expensive. Think about a $20 million property. This could be a home, because we certainly have $20 million homes in Los Angeles, or it could be a commercial property, and there are plenty of those as well. We're talking about $1.2 million in transfer taxes to sell that $20 million property. That's on top of being in a higher interest rate environment. That's on top of construction and other things just costing more. So it makes deals harder to pencil out in the city of Los Angeles. We have a question back.
That's on the sold price, that's not.
It's on the entire purchase price. It's not discounted for the amount of debt. You could be losing money on the deal and you would still have to pay the full transfer tax through Measure ULA. And there are similar things in city of San Francisco, Culver City, Santa Monica, although you don't get to quite those price tags.
Hey, Marty?
I have a different legal question, which is,
Yeah.
and I'm not sure if this is the correct name, because I'm not from California, but
Mhm.
this adjacent dwelling units, are they called ADU?
Yes.
Yes.
Does that make you a landlord when you rent out something like that?
Hmm?
And are you restricted to the same laws that landlords have?
To some extent, there are a lot of rules that do not apply when you're renting out either your house or you're just renting out an accessory dwelling unit. You're not going to have the same rules for people who are renting out 4 or more units in a multifamily apartment complex. So while you will be subject to certain rules regarding eviction, you're not going to be subject to most rent control ordinances, if that's one of the key.
Yeah.
focus.
So let me go back to ULA. So I think what's interesting about it is they estimated that there'd be $1 billion collected. What have they collected?
They've collected,
Nothing.
I think it's under 300 million. Because they didn't count on the fact that the deal volume would wind down. It's for a lofty goal. We need affordable housing.
Right.
And they needed the money and it'll able to fund that and to reduce the unhoused crisis that we're having
Homeless
here.
group, right?
Yes, exactly. But yes, clients and CPAs, we're trying so many creative ways of getting around this. Can we take a parcel, a property that's a cohesive project, sell it off legal parcel by legal parcel under the 5 million or 10 million mark? Can we divide it, assign some value to personal property as opposed to the real property? But the city of Los Angeles and other places that have this have started issuing letters saying, you tried to get around this, pay us our taxes now.
Really?
And we're
Yeah.
starting to see that.
Talk, just address the commercial side now.
Yeah.
I mean, how is the commercial market just in LA or San Francisco or down in San Diego? How has it changed just as a result of this? Are you really seeing a change in the
$5 million?
Yeah.
It will
Yes.
5 from
adjust
10.
for CPI, I think in June. Yeah, it's gonna have a CPI adjustment, so it will go up about 3% for each of the 5 million and $10 million levels.
So it will affect multifamily, right? I mean, I can
Yes.
really see this affecting
Certainly.
multifamily. It's anything commercial,
Everything.
anything that,
Anything.
if I own that strip mall and I'm selling it, I'm subject to that mansion tax
Yeah.
because I'm commercial as well as residential. No, it's a real game changer. Yes.
Super controversial, right? But
Mhm.
like,
Terrible.
talk about repealing it, I mean, about repealing that.
Oh, you're hearing that they're repealing or you want to talk about it?
About it, a
Oh.
timeline.
Yeah.
There is, there's talk about it right now.
Yes. Well, There have,
Yeah.
there
Right.
has been an attempt, certainly through certain organizations, affinity groups, and through the courts to try to pull back Measure ULA. I haven't heard of anything gaining a lot of traction.
Yeah.
Perhaps if it continues to depress sales within the city of Los Angeles, or they continue to see those trends, then maybe they might rethink it if it's not bringing in the dollars that are anticipated and also having these adverse consequences.
So Ken, let me flip to you. Just a couple things. You know, this morning I sent you the top 10 emerging self-storage markets in 2024. So I sent you that, brochure this morning. So
Right.
will you pick just for the group? Remember, there's family offices in the room. They're all trying to figure out what to do. They're either going to give their money, obviously, to your firm to manage, or they're going to have to try and find a fund, or they're going to buy out a mom and pop. If you had to name your top 3 cities in the United States that are very friendly to storage, what cities are those?
Well, unfortunately, they're Dallas and Houston and San Antonio, which are the markets that are probably oversupplied right now because it's the easiest. I mean, Houston's zoning is they figure if you have enough money to build it, then go do it. So you get some incredible, confluence of different assets in a city block. And I've got your list here, Marty, and we have stores in, I think, 8 of the 10.
Oh my God. Yeah, I sent that to you this morning. So
Yeah.
the list is Jacksonville, Providence, Sarasota, North Central Florida, Tacoma, Reno, Nashville, Springfield, Boise, and Pensacola. So this list, I just grabbed it online because I know I had, Ken here today, but it's just amazing to see, okay, where are the best places? So thank you about Dallas, Houston, and San Antonio. I'll know to stay away.
And we have a lot of stores in those Texas cities too, so.
No, I totally get it. So Marty's giving me the hook and telling me we've got a minute. So let's just go right down the group. So Anil, favorite state, favorite city for your asset class?
Florida is a particularly attractive market. Many cities in Central Florida in particular.
And Rich, I know you're doing, St. Kitts. I know you're doing offshore. I know you're doing, hotels. Anything, continental US that you really like, if you had that extra sort of $15-20 million for the 7 people in your family office to invest, where would you go?
Florida and Kentucky.
Kentucky surprised me. Why Kentucky?
There's a lot of development going on in Kentucky and Louisiana. Louisiana would be number 3.
Hurricane Alley.
It's okay.
I
People want to move there.
thought I'd hear out of
Well,
either one of
living
you,
there-
Nashville, but okay.
Tennessee and the Carolinas are doing pretty well too.
Yeah,
Yeah.
exactly. So, obviously you're not the investor, but you're guiding and you're hearing your clients come to you. What are the 2 or 3 city states that you're just hearing over and over, like, okay, this is great? Or is there a sleeper city that we haven't really heard a lot about, but you really like?
Well, I have a lot of clients that are putting significant amounts of money into the Sun Belt. So you have Arizona, you have Nevada. And there's still opportunities there that, well, they thought that Reno was going to be a great market, but bets on Reno haven't exactly paid off yet, but there's still some optimism there.
Come on, what's your sleeper that you're hearing from a lot of clients that you just, wow, really, that city?
Yeah, I still a lot of opportunities in Phoenix right now that are going on
Okay.
the multi-tenant industrial. There's some space there.
Okay, and then Marty, give me 30 seconds. We know your favorite asset class is obviously, single family. Favorite asset class?
Right now, the favorite asset class is hotel motels.
Favorite asset class?
Favorite asset is industrial.
Okay, besides storage, favorite asset class?
I don't have a second choice. That's all we do.
Oh, I love it.
We love you.
It's a great answer.
Marty, thank you.
Thanks so much.
Thank you very much. Thank you.